On December the 29th, 2025, Comex silver plunged about 11% intraday, a move large enough to blow through normal daily ranges and force mechanical selling across leveraged books. And it didn't happen after a surprise mine collapse or a shock central bank announcement. It happened right as the exchange changed the cost of staying in the game. The CME raised the margin on the March 2026 silver contract to roughly $25,000, up from about $22,000, and the market immediately showed what that really means. They said this kind of break could never happen in a market that had just been running hot. Silver had surged through 2025 and then kept climbing into early 2026. Some coverage described a near 150% rise across 2025 and another burst of roughly 25% in the first part of 2026, with spot trading above $93 at one point before easing back near $90. When price behaves like that, the crowd learns a dangerous habit, assuming the next day will look like the last one, and that momentum is the same thing as safety. Here's the pattern interrupt. Price is not the whole market. In a futures-driven arena, the market is also rules, collateral, and the ability to finance exposure. When the rules shift, the price can snap, even if the long-term story hasn't changed. That's why this move matters. It is not just a scary candle on a chart. It is evidence that the setup has entered a new phase. And this is where the information gap matters. Institutions don't need secret forecasts to move first. They watch the plumbing. They watch margin schedules. They watch clearing requirements. They watch what qualifies as deliverable metal, where it sits, and what it costs to mobilize. Retail tends to watch price. Institutions tend to watch the terms of participation. When those terms change, the setup can flip from smooth to violent without warning. Welcome to the data ledger, where we decode the plumbing before it becomes everyone's headline. We track margin shifts, vault totals, and institutional behavior, so the story is built on mechanisms, not mood. If this kind of calm, numbers first breakdown is your style, consider subscribing so you don't miss the next setup. And let me know in the comments where you're watching from, because silver hits households and industries very differently depending on where you live. Now let's reconstruct what actually happened, step by step, with the kind of detail that makes the move make sense. It was squeezed by mechanics. A Comex silver futures contract represents 5,000 ounces. When the exchange raises margin, it is effectively raising the cash deposit required to control that 5,000 ounce exposure. The difference between about $22,000 and $25,000 per contract may sound small to someone thinking in daily life terms, but in leveraged markets, it's a lever on a lever. If a trader held 10 contracts, that change demanded roughly $30,000 of additional collateral immediately just to maintain the same exposure. Put real dollars on that move. Around $90 an ounce, an 11% swing is roughly $10. On a 5,000 ounce contract, that's about $50,000 of mark-to-market change per contract in a single session. Now scale that. 20 contracts is about $1 million in variation margin flowing one way or the other. 100 contracts is $5 million. And here's the kicker. Those variation margin payments hit at the same time the exchange is asking in for a higher performance bond to keep the position open. So a participant could be facing a double cash demand, pay the day's loss, and also top up the margin requirement that was just raised. Some desks have committed credit lines and can fund through it. Others don't. When the funding can't be found, positions are reduced regardless of conviction in the selling. Pressure becomes self-fulfilling. That is why margin changes are explosive. They don't merely reflect volatility, they can create it. When leverage is widespread, the market becomes hypersensitive to collateral. A small adverse move becomes a funding problem. Funding problems become forced selling. Forced selling becomes bigger price moves. Bigger price moves justify higher margins. It is a feedback loop that can take a market that looks orderly at breakfast and turn it into a fire drill by lunch. On December 29th, 2025, that loop was on full display. The intraday decline of roughly 11% wasn't just a sentiment swing, it was a stress test. It asked one blunt question: who can post more cash right now? Those who could posted it and held. Those who couldn't had to reduce exposure. And when many participants reduce exposure at the same time, price doesn't glide down. It gaps, it lurches, and it punishes anyone who assumed liquidity would be there on demand. Then, in January 2026, the CME added another layer. Precious metals margins shifted toward a methodology framed as a percentage of contract value, effective January 13th, 2026. Think about what that means in a market that just ran hard. As price rises, contract value rises. If margin is set as a percentage, the required collateral rises with the price. In commentary around that change, silver margin was described as moving from roughly 7.2% toward around 9% as volatility surged, which is another way of saying the cash barrier rose as the crowd was getting most excited. This is the part no one discusses in plain language. Percentage-based margins can make the market feel like it is pushing back against its own rally. Rising prices can trigger rising collateral requirements, which can force some participants to cut positions, which can cap momentum even if demand remains strong. The market can look bullish and still behave brutally because the funding channel is being narrowed. At the same time, the real economy was sending its own pressure signals. Manufacturers don't care about your chart pattern. They care about input costs. Some reporting described silver's surge as spilling directly into solar economics, with one estimate suggesting silver had become around 26% of solar module production costs, up from about 3% just a few years earlier. Whether that exact mix varies by producer and design, the direction matters. When an industrial material becomes that burdensome, downstream systems scramble for substitutions, redesigns, and thrift, those adaptations take time, and in the meantime, the demand can stay stubborn. So here's the central mystery worth your attention. How can a market be described as tight, with booming narratives and strong price performance, and still experience a sudden collapse driven by rules and funding, rather than a change in physical supply? The answer is that we are dealing with two versions of the same market at once. There's the screen market, where price is discovered through contracts, leverage, and margin. And there's the metal market, where constraints are physical location, bar form, and the cost of settlement. This is not new. The playbook is older than most traders' careers. In 1980, precious metals became a battleground of leverage, public attention, and exchange control. Silver's price surged, volatility exploded, and then the terms of participation tightened. Margin requirements and trading rules changed how long positions could be held and by whom. The result was not a gentle correction. It was a violent repricing that punished late leverage and rewarded those who controlled liquidity. People remember the era as drama. The market remembers it as math and collateral. In 2011, the pattern echoed. Silver rallied sharply into spring, narratives multiplied, participation widened, and then exchange margin hikes arrived in quick succession. The market didn't need a villain, it needed only the constraint. As margins rose, the amount of cash required to hold the same exposure rose. Some participants reduced positions. Price fell. Falling price triggered more risk reduction. The sequence looked like sentiment turned, but the mechanism was more precise. The cost of leverage rose and forced the weakest hands out first. Now, in 2025 into early 2026, we saw the ingredients return, a powerful uptrend, rising public attention, and then tightening of the terms of participation. What changes from era to era is not the mechanism, but the speed. Modern markets transmit distress faster, risk systems flag drawdowns faster, funds de-risk faster, and social narratives can amplify positioning faster than ever. The sequence is ancient. The tempo is new. With that historical frame, the next question becomes, who is moving now, and how do you see it without guessing? Start with the most boring-sounding institutions, because they matter the most. Exchanges and clearinghouses like the CME are not just marketplaces. They are the risk managers of the ecosystem. Their job is to keep trades from becoming defaults. When volatility rises, they increase margins to protect the system. That is the official function. The market impact is different. They decide which participants can afford to stay. A margin hike is not a prediction about price. It is a filter on participation. Next, consider the large intermediaries who sit between speculative capital and settlement, bullion banks, prime brokers, and custodians. They care about deliverability, they care about inventory categories, they care about the cost and speed of sourcing acceptable metal. And when they sense stress building, they don't broadcast it. They adjust internal limits. They widen financing terms. They change haircuts on collateral. They become choosier about which clients can run large positions. Coordination doesn't require a meeting. It can emerge from the same incentives acting on multiple institutions at the same time. Then there are the vehicles that translate silver into accessible exposure for the public, ETFs and similar products. In the early 2026 run, reporting described roughly $922 million flowing into silver-linked ETFs over a recent period. Those flows matter because they show demand being routed into a financial channel. But the deeper question is always the same. What kind of silver is counted as backing and where is it held? Financial demand can be enormous and still be constrained by the realities of vaulting, bar standards, and settlement conventions. This is where the vault data becomes a tell. The London Bullion Market Association publishes monthly vault totals, and at the end of December 2025, it reported about 27,818 tons of silver in London. Vaults up roughly 2.3% from the prior month. On the surface, that looks like abundance. Yet at the same time, market commentary spoke about drained reserves, shortages, and manufacturing stress. Here's where it gets interesting. Those statements can both be true, depending on what available means. Inventory can be encumbered, it can be earmarked, it can be leased out. It can be pledged as collateral. It can be held in a form that satisfies one set of standards but is costly to convert for another. It can be geographically concentrated in a way that makes it slow to mobilize. And even when metal is physically present, the system can treat it as functionally scarce if moving. It, to the required location, in the required form, on the required timeline becomes expensive. That is how dislocation forms, paper abundance, physical friction. The screen price can reflect a world where leverage is forced out, while the real economy still feels tightness in procurement. Those are different layers of the same market. Now layer the exchange mechanics again onto that physical reality. When margins rise, the participants most sensitive to funding are the first to exit. Those participants often include short-term traders and momentum funds who depend on stable financing and tight risk limits. Their exit creates price breaks that look like fundamentals changed, but often the fundamentals did not. The funding terms did. Meanwhile, participants with deeper balance sheets, stronger financing lines, or physical inventory can often endure the turbulence. Sometimes they can even use it because volatility shakes loose positions at discounts and transfers, exposure to hands that can fund it. So when you hear silver fell because traders took profits, pause. Profit taking is a story. Margin is a mechanism. Mechanisms move markets. Let's make the mechanism tangible with a simple analogy. Imagine a crowded theater where everyone bought a ticket and the show is already underway. Suddenly the theater announces that to remain seated, every person must place a refundable deposit at the door, and the deposit is higher than expected. Some people can pay it without thinking, others cannot. But everyone must decide now, not later. Those who can't pay don't leave politely in single file. They push through the aisle, their movement bumps into other seats. The crowd movement becomes the event. The play on stage did not change. The terms of staying in the seat did. That is margin, it is the deposit. And in silver, the deposit became heavier, right when more people were trying to enter. Once you see it this way, the December 29th move stops being mysterious. It becomes a predictable outcome of leverage meeting constraint. But the story doesn't end with one violent day. Because right after a forced unwind, the market often reveals what it was hiding. If the move was purely speculative excess, the unwind relieves pressure and the market stabilizes. If the move was an early stage of deeper dislocation between paper claims and physical constraints, the unwind can actually intensify the scramble for real metal. A paper-driven sell-off can lower the nominal price while the physical sourcing challenge remains. That combination can create strange behavior. The screen looks weak while the procurement side stays tense. This is where two markets start telling opposite stories. On one side, the paper market shows rising costs to hold positions. Percentage-based margins mean that as price rises, the collateral requirement rises too. That discourages leveraged long exposure and can cap speculative momentum. On the other side, the physical market can remain tight if industrial demand is sticky and if available, supply is locked in the wrong places or forms. Those conditions can create persistent differences between financial quotes and real-world sourcing costs. The divergence doesn't have to last forever, but it often lasts long enough to mislead anyone who assumes one quote equals the entire truth. There is also a timing mismatch. Futures markets can reprice in minutes. Physical supply chains reprice in weeks. A refinery cannot instantly change output. A manufacturer cannot instantly redesign a process. Logistics cannot instantly reroute material without cost. When funding shocks hit paper markets, the screen can move violently while the physical system is still operating on older assumptions. That lag can make the market look irrational. It isn't irrational. It is asynchronous. Now connect the dots with the evidence already on the table. We have the sharp move, about 11% intraday on December 29th, 2025. We have a mechanical trigger, a margin hike that took the March 2026 silver contract to roughly $25,000. We have a structural shift, percentage of value margin methodology, effective January 13th, 2026, with commentary describing margins around 7.2% moving toward 9%. We have a demand pressure narrative, solar and manufacturing cost strain, with estimates showing silver's cost share rising sharply. We have financial flow evidence, roughly $922 million into silver-linked ETFs in a recent window. We have vault totals, roughly 27,818 tons in London at the end of December 2025. Those are not opinions, they're anchors. And when you place them together, you can see a setup that looks less like random volatility and more like a system shifting phase. A phase shift is when the same inputs produce different outputs because the constraint changed. In calm periods, more demand tends to mean higher prices, and higher prices attract more participation. In stressed periods, more demand can collide with funding constraints and delivery friction, producing oscillations rather than smooth trends. The market can rise fast and fall faster. Not because the story is false, but because the vehicle carrying the story is unstable. One more nuance. Margin hikes don't hit everyone evenly. Hedgers using futures to lock input costs may be forced to shrink coverage, which can increase their exposure to spot tightness. Speculators may exit entirely. That changes the mix of participants and the texture of liquidity. When liquidity thins, even modest orders can move price, making the next shock arrive faster than expected, dramatically. So what does this mean going forward without pretending to predict a single outcome? Historically, when exchanges tighten margins into volatility, the market tends to move toward one of three broad paths. In a conservative path, volatility burns itself out. Price consolidates. The margin framework stabilizes, and participants adapt. The market becomes less leveraged, and price discovery shifts toward those with genuine balance sheet capacity. The story becomes slower, more orderly, and less headline-friendly. The market still moves, but it moves with fewer forced liquidations. In a moderate path, the dislocation persists. Paper participation remains constrained while physical demand stays firm. In that case, watch for repeated episodes where price drops sharply on margin and funding news, then rebounds on procurement pressure. The market becomes a sequence of shakes and snaps rather than a straight line. This can feel chaotic, but it is the system searching for a new equilibrium. In a more aggressive path, the gap between paper and physical becomes impossible to ignore. That rarely shows up as one dramatic day. It usually shows up as a series of small fractures, changing delivery incentives, increasing cost of mobilizing metal, shifts in inventory categories, and sudden bursts of volatility when a large participant has to source in size. In that world, the headline price can lag behind the stress in the system until pressure forces repricing. If you want indicators that matter, keep them grounded. Watch for further margin adjustments and the language exchanges used to justify them. Watch for changes in contract specifications and delivery terms. Watch vault totals, but also listen for discussions about availability versus presence. Watch ETF flows, not as a simple bullish or bearish label, but as a measure of how much demand is being routed through paper channels. Watch volatility itself, because volatility drives margin and margin drives participation. And watch behavior around key contract months. Markets often express stress at rollover points, when positions must be moved, closed, or financed anew. When financing becomes more expensive, rollover becomes a moment of truth that can produce sudden air pockets, even in a broader uptrend. Now, here is the divide that separates those who get caught in these events from those who understand them. It is not about being smarter. It is about paying attention to the right layer. Most people focus on the storyline and the price because that is what is visible. But the wealth gap in markets often comes from the information gap about mechanics. Institutions moved first because they read the rulebook first. Retail tends to move last because they only see the consequences. When margins rise, it is not a debate. It is a demand for collateral. Collateral decides who can wait and who must act. Not because the outcome is guaranteed, but because the system has already revealed the critical constraint. The constraint is not whether silver is important. The constraint is whether participants can finance exposure and whether metal can be mobilized without friction. When those constraints tighten at the same time, volatility stops being a surprise. It becomes the language the market uses to renegotiate who holds risk. If this connected dots you hadn't been holding in the same frame, keep that frame. Silver right now is not just a chart. It is a negotiation between paper claims and physical constraints moderated by exchanges that can change the cost of participation overnight. The setup is not hidden. It is printed in margin schedules, in vault totals, and in the behavior of flows. This is the data ledger, where we decode what matters before it becomes the headline. And the question isn't whether a market like this produces another violent move. The question is whether you recognize the shift when the rules change, or only after the move forces everyone else to notice.